Venugopal joins us now and represents Bernstein. Good to have him back and good to see him smile. It's only one day move. No reason to smile. Maybe everybody's smiling very early.
Nikunj, I was hearing your bullish comments in the last few minutes, and that's why I was smiling for that.
No. All I'm saying is that when you just think about it, let's say we were in Jan first week. There were four concerns. What will Fed do? What will happen in election? What will happen to what will happen to Trump tariffs? What will happen to budget? And what could happen to earnings? Frankly, we've been on the right side. So the concerns which really were dragging the markets down, they've been addressed very nicely.
I agree with you, Nikunj. If you sort of read my outlook report in I think on 1st or 2nd of January, I had primarily decided to shift from a very cautious mode in India. And last 6 months of the previous year was very, very negative to a slightly more constructive view on India. In fact, I had moved to something I call it as a buy, which is a selective buy with a 12% return on Nifty, which is a positive return. And my viewpoint was that macro has bottomed. I was also of the view that one has to take a view on what is going to happen with respect to Trump's tariffs. And my view was it is not likely that we head to 60% tariff. I mean, he could, but I had to take a view. I said it's not going to be possible. It would eventually get negotiated out. Dollar index probably would peak at some point of time, which will also enable India to cut rates later in the year. It was more a later in the year script. So these factors primarily was what made me a bit more constructive on India overall, but SMITs, I was still a bit worried on valuations, right? So it was more a nifty sort of a large cap view. So don't really disagree on your bullish comments, but I don't know whether bullish is the right word. Positive and constructive probably are the right words to use.
Right. So Venu, let's analyze, your note which came by after the budget, right? And you very rightly started it with the $15 billion question for the middle class. I mean, of course, there have been very exuberant reactions. A lot of people have suddenly turned tide towards a bullish view on consumption now. Tell me, how do you think this entire saving that the middle class is going to incur now post the budget tax slab changes, how do you think that's going to spread out?
Yeah, so consumption side of things, honestly, I was warming up a bit. The fact that I had added a few discretionary names in my India portfolio as well in early January. And by that time, actually, in the first week or week and a half of January, we had started to already get this noise about potential tax cuts as well, right? So that was another angle which was sort of implied in the model. But if you were to just think about it, the $12 billion odd tax cut, of course, the actual spends could depend on two things. Number one is that you could always take a leverage to invest, which is basically take credit and leverage that amount and spend a bit more. And number two is there is a broader school of thinking that old tax versus new tax, you probably don't need to save as much, so maybe there is some bit more of dollars which can come in for spending. Now, in theory, the way I look at things is a consumer primarily is not going to wait for an year to spend. So if he wants to spend, he or she wants to spend, it is going to be primarily in the next 2 quarters. So while capex is linear in some fashion, consumption is going to be relatively more non-linear. So the data on volumes is going to be very critical. And I also think that a large part of the money, if it doesn't go into SIPs or investments, which I think is not going to be the case, there'll be a larger propensity to spend for that category of consumers. It's going to be in discretionary rather than staples. So any choices somebody has to be making with respect to consumption, flavor, or volumes has to be more around small values, small ticket discretionary, could be affordable vehicles, which is essentially not affordable vehicles of two-wheelers, but affordable vehicles in cars, bit in maybe QSR spends, and very selectively on things like consumer durables, which I again moved back up to an overweight after the correction we saw the previous month. So that's a broad flavor, but the argument is next 6 months, not about something which is going to happen a year later.
All right. The bigger question after the budget has been whether now this is the end of the government capex cycle or not. And, as an investor, do you need to pick from either pools, consumption versus capex, or do you need to have both?
The reality is you could be selective in capex as well. If you were to think about it, firstly, is it the end of the government capex cycle? I mean, that's a pretty bold term to use. I did use it more from a perspective that at least in the near term, it does look like the case. You cannot really see the 30% capex allocation growth that the government used to do. More importantly, they've been signaling saying that we want private sector to start to invest. They also were talking about PPP projects, which I think never works. So that will be probably very disappointing if that route is used. But the reality is government is no longer going to do the heavy lifting for capex. We have to live with that story. Now, within government capex, I mean, areas like power or areas like metro, for example, there was an increase in allocations. And that's an area we could probably see positive surprises also come through the year if things like power demand starts to improve, macro starts to improve. So you could be selective specifically in those areas as well. I mean, we are overweight utilities largely because we want to play power through a relatively more better valuation, especially the government utilities, rather than trying to play it through, 70, 80 peaks, PE worth industrial stocks where we are underweight, right? So that's the way we are managing it at this juncture.
Venu, so if I connect the dots here, what you essentially are indicating that for 2025, the best trade is the recovery trade. Wherever dullness or dimness in the economy has come, that will start normalizing. So bet on the recovery trade. It will not be as big as, of course, the COVID recovery trade, but there would be a recovery trade which is at play. So for investors to bet on the recovery trade, what is the best way to really bet on this so-called recovery trade? What would benefit the first? That is what we need to identify.
It's very tricky to say that, but I'll tell you why. Because, our entire construct of recovery trade was also centered around a couple of sectors that we like. That's number one. And also was very specific on stocks, saying that wherever we saw damage to individual companies because of, let's say, very poor performance last year for specific reasons, if you see normalization, why not be in those stocks? So let me put a very quickly on the sectoral construct. See, financial sector hasn't really done wonders in terms of performance last year from a stock price perspective. If we're talking about easing, if we're talking about macro recovery, we're talking about consumer perhaps leveraging a bit, in this tax cut cycle, is going to be helping financial sectors in general. So that's one way to play it. But we decided to take some risk. I usually don't mention stocks, but for example, we decided to add an IndusInd in the India portfolio because it had done so badly last year. So that's a way we're playing that. Similarly, the second sort of area where I would probably say at this juncture looks more viable is things like consumer durables, which essentially have seen a big correction in the previous month. That's also some form of a recovery trade in from that perspective. See, outside of this, quite a few of them are individual stock specific names, be it within industrials in Adani Ports, for example. So those kind of, stocks which have corrected quite a bit, or a Bharti, for example, which corrected quite meaningfully in the end of the previous year. So stock specific and bit of a sector specific flavor is the way I would put it. We are underweight industrials, as I said. We are overweighted utilities, and here also the largest government utility, thermal one, also looks like a recovery trade in some sense, given that it's corrected meaningfully from the peak. So that's broadly what it is, Nikunj. It's a pretty hodgepodgey bottom-up selection of largest sort of a caps that we are participating in.
Hi Venu, this is Shrishti also joining in. But Venu, when you suggest to start buying selectively, when we see your portfolio, you have taken down two of the large cap names, that is Reliance as well as HDFC Bank. Given that everybody is talking about to increase the exposure in the large cap space versus the small and mid end of the market, help us with your understanding and what's your rationale on both of these large cap measures. Do you believe that going ahead in 2025, what's not exciting for you in both of these names at least?
Okay, two things. One is we still like those stocks from point of view of ratings. Both are outperform rated stocks at Bernstein. Right? So now the question simply is that they are also very high index weights. I mean, put together probably they'll have 23-24% index weight. Now, I didn't want to really hug around an index because my idea was to figure out opportunities in stocks which have materially corrected, along with the combination of stocks which are relatively smaller index weight but may not have fallen. For example, ICICI Bank did well, but still we kept it. So it's a combination of that. It's also a call on the index weights as well, because the idea was to play recovery rather than play safety. And second thing is, fourth quarter was tough for us as well, the previous year, where despite being negative on India, we still run a portfolio and we did see a drip, and we want to basically recoup those gains. The third thing is we want to be nimble this year, because we do believe volatility will rule. We would get opportunities to invest in stocks that we would probably want to be investing in. So that's another thing which is left for the future. So what it means is the India portfolio that you see today is not cast in stone for the next 12 months. It could churn every month or every 2 months. Earlier, we used to just churn it once a quarter and never touched it between a quarter. So that's the other change in strategy for this year as compared to the previous few years.
All right, but Venu, also wanted to have your sense on the FII's positioning right now, because what we are seeing is that after so many sessions just yesterday, there was a buying figure indeed, very minuscule, but help us understand that, is it enough to cheer about? Has anything changed with respect to FII's questioning or their positioning post-budget? Since you keep talking to a lot of these FIIs, help us understand the sentiment there.
See, the FII sentiment is very interesting because I see them a bit more positive compared to domestic mutual funds when they sort of discuss about opportunities and what to buy. So I did probably get a sense in my recent meetings over the last month that they're not really negative per se on individual stocks or on India at this juncture as to where we are on the market. But they have their own constraints, and those are allocation constraints. Quite a few of them have seen redemptions. That's how the challenge they need to run with. So the limiting factor, of course, is how much of allocations goes to developed market and versus EM, and within EM, is China a better way to play than India? So those are calls that they need to take. Right? So that's where we are in the FII world. And remember, one more aspect is that rupee depreciation is also fundamentally a challenge for them. They're dollar return based investors. So if you're going to be seeing sudden sharp declines in rupee, it's not something that they get comfortable with. So once you have a semblance of tariffs as to where they're heading, if you see inflationary risks sort of moderate in US and globally, and you see dollar index truly peaking and EM currencies starting to behave well, I think that's the point at which you would see a larger flow of FIIs, money coming in.
It's just that we've been waiting for them to come back. 6 months, we've used taglines, at least on ET now. Kahan jayenge FIIs? India is the best place to be in. The economy is growing at 6%. Macro is coming under control. Growth may have slowed down, but it is not that bad. I mean, I look at other countries also, the macro is, forget is bad, the macro is in a mess. And then FIs, they buy dollar. So I don't know, what am I missing on, or I need to revisit and perhaps understand the marginal theory of utility again, or perhaps understanding economics again. Ye kya ho raha hai?
Nikunj, the reality is this. I don't know whether you recollect a conversation when I was at your studio, I guess exactly 12 months back, where I had made this comment that FIIs are not going to come back. I was very vocal on that. And that was based on my interactions and conversations. See, I think a lot of us who track India believe India is important, right? That's the fundamental reality with which why we are working in India and operating, in Indian markets. But FIIs have a lot of other considerations before they decide, calls between emerging markets or calls between developed and emerging markets. Ultimately, a pool of money that they need to allocate. So over a period of time, it's very, very clear to us that, FII's importance in the Indian market is going to only reduce over time. And we have to live with that, because purely from a capability standpoint and in terms of bandwidth, in terms of intensity of knowledge, eventually to a large extent, it will be the domestic institutional investors who are going to be ruling the Indian markets. That's a structural trend that is going to shape up over time. So we have to live with that reality unless India scales up so materially up as an economy that it starts to become an asset class of its own, and FIIs get forced to invest rather than being discretionary investors.
Great to have you on the show. Thank you so much for your time today.
Thanks.